Return on investment. The importance of this is within the name. What is my return that I'm getting relative to the investment I'm making in my business? The calculation for return on investment is your EBIT, or your profit, divided by the equity you hold within your business, because the equity is ultimately your investment. We naturally want this number as high as possible. If we have $100,000 of profit and $500,000 worth of equity, then that's a 20% return on investment we've achieved. What is a good return on investment? I believe if you're running a small, medium enterprise, and medium I would define up to around $200 million in turnover, is you want to be getting a return on investment of around 30% per year. If you look at famous investors, they aim for lower returns on investment. But remember, they aren't the ones actually doing the sweat and toil for the investments that they are making. They are passive investors, whereas we're looking at businesses where you're actively involved in the day-to-day operations of the business. How do we influence this number? Well, firstly, we want to optimize our profit. That's where we live, that's where we spend our day-to-day. But the second part of the equation, the equity, does become quite interesting. If we go back to that example of $100,000 worth of profit, but what happens at different stages of our equity cycle? If we're in the early phases of business, we're likely to get very high returns on investment because we haven't built equity that significantly. If I use a larger business example of $1 million worth of profit and $2 million worth of equity, they've got a 50% return on investment, which is excellent. But if that business grows and grows and grows, but continues to build its equity base, but it keeps its profit at $1 million, do you think that becomes a good return on investment? The $1 million profit is still the same dollar value, ignoring time value of money and things like that. But if my equity is now $10 million, that's only a 10% return on investment. So as we said a moment ago, the first part of the equation that we want to influence is increasing profitability. That's obvious. But the second part is, what do we do with our equity? And if we've got equity within our business that we aren't getting a satisfactory return on, we need to seriously consider returning some of that equity to our shareholders. If we're going to stay at $1 million worth of profit a year, we don't necessarily need $10 million worth of equity just sitting there. We could probably return 70% of it. You can work out what you need within your business and return the rest to shareholders. This is something you would want to talk to your tax accountant about at a practical level, but as your business grows, your equity growth becomes an anchor to the performance of what you achieve on return on investment. So don't forget, how that equity is used is just as big a dictator to your return on investment as the profitability itself.